Thank you, Alastair. I'm sitting here next to our regulator, who I feel like we're almost partners because they work very closely with us. And indeed, the Greek banks are thankful to them because they gave us the time to adjust. We went through a major crisis 10 years ago. Banks were destroyed, they were recapitalized many times, and we finally made it. And now we have turned the page. And I'll just quote you some numbers to substantiate that. About 8 years ago, half of our loan portfolio was non-performing. That was back in 2006. And now, at the end of December, only about 6.6% of that is non-performing. It's going down fast. Of course, the European average is about 1.8%, so there's more work to do, but we're working on that, and we think we'll succeed. The banks are well capitalized. Elizabeth mentioned capital. Of course, it's the number one item that SSM looks at. The capital ratio, the core equity tier 1 for Greek banks, the average was 15.5%, very close to the European average, which was 15.7% in December. And Greek banks also have plenty of liquidity. They satisfy all the requirements of the regulators. Essentially, the loan-to-deposit ratio back in December was like 67%. There's a lot of money out there to be lent. So we're looking for good businesses to lend money to. And something that I'd like to stress is the stress tests of SSM, of the 2023 stress tests. The Greek banks did extremely well, exceptionally well. They had the 5th, the 12th, the 13th, and the 19th position among 109 European systemic banks. This is something to actually be proud about coming through after a crisis. And finally, I should say that 3 of the 4 systemic banks already have investment grade, and in the last 2 years, banks finally are profitable. And this year, for the first time after 16 years, we are going to distribute dividends. This is a signal to the market that we're coming back. Normality is back with the Greek banking system. So the question is, what about next? Some people say, okay, you're profitable because interest rates went up, so it's a cushy time. What about next year when rates are going to come down? Are you going to lose profitability? And I'd say what will make us sustain the profitability is the fact that lending keeps expanding. And that's driven by economic growth. And as you know, a country that does well economically, its banks do well as well. And the markets have realized that, by the way. In the last year, the Greek systemic banks, their price-to-book values have gone up, some of them to 0.9, which is very close to where Europe is. So things are well, and I think the market thinks, and everybody thinks, that the good times is not a temporary phenomenon. They're going to last. Are there risks out there? Of course there are risks. You mentioned, Elizabeth, digitalization. This is something that concerns us. The Greek banks are trying to transform themselves. They are digitalizing fast. And the question is, this is a common to all European banks. Are they digitalizing fast enough relative to what the demand is out there? Because they have competitors, not so much the fintechs, but the big techs. Okay, so they need to work hard. But the biggest risk is economic growth in Europe, I think. And the economic growth can suffer from the political rivalry of the superpowers and the conflicts in our region. We know this very well. Europe particularly can suffer because it cannot compete as easily with the superpowers because it doesn't have its own industrial policy. It cannot yet act as one entity. It still needs consensus. It takes time. It's very hard to compete. And then there's the green transition, where Europe has taken the lead, and it's costly. In general, growth is something we have to worry about. When it comes to digitalization, it's up to the banks, and there they can control the risks a lot better.